Welcome back, Alpha Hunters. Okay, so today's video we're going to talk about one of my favorite topics to talk about, is divergence. I really like this topic. It gives us great indication for stronger movements for us to play, or a significant kind of change in direction of the typical market movement or the trending market movement. So we're going to look at plenty of scenarios and how to read certain divergences. Okay, but if you don't know what a divergence is, well, let's go over to Investopedia and just figure out what divergence is. Okay, so this is going to be the basic definition of divergence, and we'll just scroll down here to the highlights. And a divergence can occur between the price of an asset and almost any technical or fundamental indicator or data. Though divergence is typically used by technical traders when the price is moving in the opposite direction of a technical indicator. So that's very important to know, especially this last part right here, moving in the opposite direction of a technical indicator, because that's pretty much what a divergence is. Now, I'll leave this link down below in the comment section so you can come back. If you want to look into this a little bit more, I'm not going to worry about all the other aspects here because I'm going to give you some highlights and some tips, okay? So let's go back to the chart, and we're just going to look at the the S&P 500 futures, basically from the beginning of 2020 to roughly the beginning of 2022. And there's several spots in here where there's some pretty good indication of divergences. And so we'll just kind of talk about what they mean. But let's talk about some tips about divergences. The first one is never factor in or compare to volume. Never do this. I see this done sometimes every now and then, especially like when the market's coming out of a major sell-off or bear market. This is a very wrong use of divergence. I'll give you a clear indication of that when we get back to the charts. Tip number 2. Most divergences will be called out on the MACD or stochastics, RSI. So if you do see these called out, they will be called out usually on the MACD and stochastics. But any momentum indicator can have a divergence relationship. As we just saw on the Investopedia website, they did say any indicator can have that. So yes, any indicator can have those, because most of the indicators that you will find out there are built around the MACD and the RSI stochastics. Those two are the main foundations to a lot of indicators that you have out there. Now, the next two tips are going to rely mostly around just the general market principles. If you like to do sideways stocks that trade sideways, this probably won't work for you, but this will work for most of the times that you track just the general marketplace like the S&P 500. So tip number 3 is bullish price and a bearish indicator most of the time leads to a price resting period. But these also typically signal market tops. Okay, so how do you really know what's the difference between a resting period and a market top? Well, let's look at tip number 4. A bearish price and a bullish indicator will lead to more downside, usually pretty significant. So when I combo a 3 and a 4 and I see them kind of back to back, I see a bullish price and a bearish indicator divergence, and then shortly thereafter or some time period thereafter, I usually see a bearish price and a bullish indicator divergence. Those are when I typically start to get a little bit more cautious on the market, start to look for more significant downside and that kind of environment for the marketplace. We will look at an example of that in the early 2022 time period. So first things first, let's look at why you should never want to look at volume as the indicator for divergence. So I'm gonna turn off this auto thing here, and we have this COVID crash that we had in the beginning of 2020. Well, one of the issues with looking at volume is during major market sell-offs, you typically have higher volume environments. Okay, so when you go into a bear market, you're gonna have more volume the farther down you go. And so when you have major market moves, especially like we did in the COVID crash, this was so rapid that we had an uptick in volume. Now, if we look, as you get to a more normalized market and we start to see more just bullishness on the market, volume starts to normalize out. So we see a decreasing of the volume as the market gets into more of a bullish market. So sometimes people will call out, say, hey, we're seeing a negative divergence here on volume, but that's not typically going to lead to downside in the stock. And you go from a lower stock price to a higher stock price, and then you go from a higher volume to a lower volume. That's not the divergence you want to look for. So this is why you never want to factor in volume. Volume is not a major factor for divergence. You should never look at it as such, okay? Because as you come out of highly volatile time periods, the market will start to normalize, especially around volume, and people will call this out. You will see it, and they typically do not know what they are talking about in respects to divergence. So if you ever see someone talk about divergence and volume, just shake your head and leave them alone. So now let's look at a divergence though that we had at the beginning of the COVID crash, the COVID peak, just before the COVID. And I'm gonna use this replay feature so that I can show a little bit more on this MACD here. And I'm going to hide all of that thereafter. So what a divergence is, a really good divergence, is when we see higher peaks, right? So we're seeing a higher peak there. Let me go ahead and turn auto back on. So we get clearly a higher peak, and then we get clearly lower peaks on the indicators. So that's the one on the MACD, and then the one on the RSI down here on the stochastics is very clearly lower. Okay, even more so than the MACD. So we are seeing a very significant divergence here. This is very much a clear indication that the market has some issues. But if I scroll this forward, we can see, we started to have some significant downside on the market as COVID really started to affect the marketplace and the economy. So this is one where the divergence definitely worked out and definitely called a little bit more of a top here, with the COVID crash being a little bit more of a marketplace one-off. It was something that the marketplace had never seen before. We had never seen how the market was going to respond to a pandemic. So that is one example of a divergence. So another one I'm going to show off here is similar kind of thing, but we have a higher peak here on the price, and then we have a lower peak here on the MACD. Okay, so we have a little bit of a lower peak there on the MACD with a little bit of a higher one on the price, and we can see it was really just more of a resting divergence. We just rested here for about 2 months, kind of just went sideways. We chopped around a little bit, and then the market started to turn back to the bullish trend. And these are typically going to be the normal that you will see in bullish type trends. You will see these a little bit more often than not, where you'll have higher peaks and then you'll have a little bit lower peak on here on the MACD. These will be typically more resting type divergences that you will see in a bullish trend. You will see these quite often. So here's another relatively minor one, but we have one here to that little uptick with the stochastics and MACD really both kind of showing this one where we have a downtrend on the MACD and the stochastics. And then we just got a little bit of a rest there shortly thereafter. Not much, not a major one, but it was just a market rest period that I still wanted to kind of just show you for example. So here's another pretty good one that we got from roughly mid-April of 2021. As we had higher peaks into the later part of August, and then we got some declines here on the MACD and really the stochastics, although the stochastics was really kind of a narrow, a short divergence, but it's still a divergence, still counts. And we can see that the market just kind of rested. We just got in there and rested for a little bit, but it was a little bit more significant of a resting period that we did have on the marketplace there. So we then had another one, a really good one, in the later parts of 2021, where we had higher price action, and then we had lower peaks here on the MACD and also the RSI, which leads us to have a little bit more of a down period. But this one was going to be a little bit different, okay? And the way I like to see kind of my tip 3 and tip 4, right, where we get the bullish price divergence with the negative peak divergence on the indicators. But we haven't really looked at the divergence where we have lower price peaks and higher indicator peaks, okay? And this is why they don't happen this often, okay? These are typically spotted when we go into a stronger selling period, a stronger down period, more of a bear market type indicator. When you see these, you need to be very cautious about the market. And there is one spotted right here, we have a negative price action down to this peak, and we can see that we have a bullish indicator pattern here. And we see this on the MACD and the RSI, where we have both indicators having higher peaks on the indicators, and we see lower price action. This is typically when you will see significant downside come into the marketplace. This is kind of what you're looking for, where you get kind of my step 3, where you have a bullish price action with bearish indicators, okay, come in. Now these are typically also resting indicating patterns, so you got to be real careful not to be overly aggressive to the bearish side. But once you then get the bearish price action to come in with bullish indicators, that is a more significant indication of future downside. These are patterns you don't typically find on the market all that often, but when they do, they can indicate a very strong downside is coming in the near term. Because what you see then after that is pretty solid selling then come in after these patterns have been established, okay? So those are kind of some of the tips. That's kind of what I wanted to show you. Most of the time you will not see my tip number 4, the bearish price action with a bullish indicator type divergence. You don't typically see those on the marketplace all that often. It's going to be the ones that you see where you have the higher price action with the bearish indicators. Those are typically the ones you're going to see a lot more often, especially as the market's in a normal trending bullish market. Those are the ones that you're going to spot a lot more often. With most of the time, they're just going to lead to resting periods, and there's not going to be major things to worry about. The times where there's going to be major things to worry about is when you get the divergence with lower price action and higher indicator type movement. That's when you start to see some real significant downside moves. So hopefully this was beneficial for you as we walk through several scenarios, the ones you want to look for, ones you don't want to look for, ones you really want to pay attention to be a little bit more cautionary on the market and to understand when to potentially protect yourself for more significant movements to the downside. Alrighty, take care, Alpha Hunters.